Welcome to Talk Tickers. Today we are taking a deep, concentrated dive into the Morgan Stanley earnings call for Q4 and the full year 2025.
And this one was a big one.
A very big one. We've got the transcripts, the deck, all the notes. And our mission here is to really cut through the noise. We want to explain not just what happened, but why this report was such a pivotal moment for the firm.
It absolutely was. I mean, this wasn't your run-of-the-mill report. The market's reaction was immediate and very strong. The stock just jumped.
Right.
And that kind of confidence, it tells you that investors saw this as a real validation of their whole integrated strategy.
So that's our job today. We're going to unpack these, frankly, blockbuster numbers, dig into why management is staying so disciplined even after hitting their goals, and show you how this whole integrated firm idea is actually paying off.
Let's do it.
Okay, let's jump straight into the headlines then, because the numbers themselves are pretty staggering. What were the key figures that got the market so excited?
It was a clear, decisive beat, top and bottom line. So for the fourth quarter, GAAP earnings per share, it came in at $2.68.
And the consensus was what, around $2.45?
Exactly, $2.45. So they just crushed that. Then on revenue, the firm booked $17.9 billion against an expectation of was $16.71 billion. So really comfortable beat there too.
That's a strong quarter for sure. But what about the full year? Because that's where you see the strategy, not just a bit of cyclical luck.
And the full year 2025 was, it was exceptional.
Yeah.
Record annual revenues of $70.6 billion, record EPS of $10.21. But look, the number we really have to focus on, the true measure of capital efficiency, is the return on tangible common equity, the ROCE.
Right.
They delivered 21.6% for the year.
Yeah.
That puts Morgan Stanley in the absolute top tier, period.
A 21.6% ROCE is, it's not something you just stumble into. It's the direct result of the business model working. So let's unpack that, this integrated firm strategy. The idea of combining that sticky, super profitable wealth management business with the more opportunistic, cyclical, institutional side. How's that looking now with total client assets at a massive $9.3 trillion?
That scale is the defense, right? It's the fortress.
Yeah.
But what we saw this quarter was the offense really coming alive in the Institutional Securities Group, the ISG.
Okay.
ISG delivered record full-year revenues of $33.1 billion. But here's the fascinating part. Management specifically said they gained 100 basis points of wallet share across investment banking and markets.
Wow. A full 100 basis points of market share is not a small feat. In that field, that's huge. That suggests a competitor is really dropping the ball somewhere.
Or that your platform is just that much better when the markets turn on. Look at investment banking alone. Q4 revenue was up a massive 47% year over year.
47%.
To $2.4 billion. That was fueled by a record quarter in debt underwriting. And crucially, advisory results crossed the $1 billion mark. Management's tone was, very confident. They said pipelines are healthy, they're global, and they're perfectly positioned for the 2026 capital cycle.
So they're not just riding the wave, they're actually taking share while the wave is rising.
That's the story.
And the trading floor backed that up too, because sometimes you see IB surge in trading lags, but not here, especially not in equities.
Not at all. Equities delivered record full-year revenues, $15.6 billion. In Q4 alone, $3.7 billion, driven by higher client activity. But the deeper insight here is the growth in their derivatives business.
Okay.
Historically, that was, seen as a bit of relative weakness for them compared to some rivals. The fact that they're calling it out specifically, it signals they've basically closed that competitive gap. Their whole institutional offering is just much more complete now.
So if the institutional side is the powerful offense, it only works if the defense, the wealth management business, is holding firm. That's the ballast. What did the margins and flows tell us there?
Wealth management is just this engine of durability. It hit record full-year revenues, $31.8 billion, with a margin of 29%. But here's where it gets really interesting.
Go on.
The Q4 margin expanded even further. It hit 31.4%. Management said on the call, this was the highest margin level they have ever printed for the segment. Ever.
Wait a minute, hang on. They had a long-standing goal of getting wealth margins at or above 30%. They didn't just meet it, they blew past it to 31.4%. So if they're exceeding targets, why didn't they immediately raise the bar for 2026?
This is where the real story begins, I think.
You've just hit on the central puzzle of the entire call. We'll get to their philosophy in a second, but that margin expansion, it just proves the efficiency of the platform. And you see it in the growth metric, too. Net new assets, NNA.
Right.
They brought in $356 billion in NNA for the year. Over the last 5 years, that's $1.6 trillion. The huge cumulative number, but what about the funnel? Are they actually converting those brokerage clients into higher value advisory relationships?
They are, and this is the proof of the integration. Management said flows from, the self-directed side to financial advisors accelerated to $100 billion in 2025.
And the historical average was what?
Around $60 billion. So a $40 billion acceleration. It shows the strategy is working and it's being driven by tech.
Which leads us straight to AI. Because they're not just using it to cut costs, they're using it to drive revenue.
That's the critical distinction. Most firms talk about AI for, back office efficiency, and Morgan Stanley is doing that. They talk about having one human team and one AI team checking documents, which drives massive operating leverage. But they're also focused on effectiveness.
Meaning revenue. What's an example?
The main one they gave was a tool called LeadIQ. It's an AI tool that helps advisors identify clients who are showing behaviors that signal they might want financial advice. So the advisor goes from making a cold call to a targeted value-add conversation.
It's AI as a revenue accelerator.
Exactly. It makes the human advisor better, not just cheaper.
That strategy, using AI to boost a $31 billion revenue stream, that's how you build a real competitive moat. It feels like they're widening the gap.
For sure. And that brings us right back to that central puzzle. You've got record results, share gains, margins exceeding targets, and yet management chose not to raise the firm-wide goals, like that 17.5% ROCE target.
So what was the thinking? I mean, the market loves it when you raise targets. Why the restraint?
Management's answer, and this was led by Ted Pick, was all about rigor and humility. He said the goal is to operate at a higher plane of operating performance through the cycle. They're playing the long game.
So what does that mean for you listening? Are they just sandbagging, setting a low bar they can easily beat, or is it something deeper?
I think it's philosophical. They aren't chasing that immediate dopamine hit of raising targets. Ted Pick said, and I'm paraphrasing, that this is not the time to overreach. It's the time to show you can consistently compound earnings.
They're aiming for higher lows.
That's the phrase they used, higher lows. Meaning, even when the market is tough, that durable wealth engine means their profitability doesn't just fall off a cliff. By showing that consistency, they're playing for a structural re-rating of their PE multiple. They want to be rewarded for quality, not just for cyclical upside. They'll revisit targets in the late year.
That long-term focus is also really clear in how they're managing their capital. They're sitting on a mountain of dry powder.
They really are. Their CET1 ratio ended the year at 15.9%. Now, critically, that gives them over 300 basis points of excess capital above what regulators require.
And just to put that in context for everyone, 300 basis points is
billions of dollars. Billions in unutilized capital just waiting to be deployed.
But despite that, management said the bar for M&A is super high. They seem to be walking away from deals.
It's that discipline again. They're being patient. They said they prefer organic investment right now because valuations are high and, maybe more importantly, big integrations are really, really hard. They know that from E-Trade and Eaton Vance. So they're choosing capital preservation over a whiskey deal.
And instead, returning that capital to shareholders.
Yep. They raised the dividend again by 7.5 cents to $1 per share. That's the fourth straight year of increases. And they bought back $1.5 billion of stock in Q4.
Okay, let's connect this back to their global footprint. This capital markets recovery isn't just a U.S. story.
Not at all. It's a key driver. 25% of revenues from outside the U.S. And the growth there is, it's pretty outstanding. AMIA revenues up 40% and Asia revenues up 50% over the last 2 years. They specifically highlighted being highly differentiated in markets like Tokyo and Hong Kong. They're leveraging that global scale.
So what's the forward look? If we think about the size of the whole capital markets pie, what was management's take?
They're bullish, but in a measured way. They view the capital market cycle as being only in the third inning.
Meaning, there's a lot more game to be played.
A lot more. They see a long-term tailwind from global consolidation, the equitization of markets, and this huge backlog of big private companies that have to come to the public markets eventually.
And did they put a number on the growth of that total market?
They gave a rule of thumb. They estimate the global capital markets wallet could grow 5 to 10% per year. Think nominal GDP times 2. And they are very confidently playing for share gains within that growing market.
All right. Now we're going to transition to our segment, Not Financial Advice. This is where we step outside the transcript and pitch an outrageous but plausible trade idea based only on the evidence from the call. And remember, listener, this is purely for entertainment and education.
Yeah.
It is absolutely not real financial advice.
Okay, so the trade thesis here is a long-short pairs trade. It's a bet on managerial quality. You go long Morgan Stanley and you go short PRX.
And PRX is what?
PRX is a hypothetical competitor, one with high cyclical exposure, a much weaker wealth platform, and, critically, management that's chasing growth through big, expensive, maybe poorly priced acquisitions.
So you're betting on durability versus volatility?
Precisely. Look, the market is already rewarding MS for the cyclical snapback in trading and IB. What it's still underappreciating, I think, is the sheer durability of that wealth engine, which is printing margins over 31%. The refusal to raise targets, plus that 300-plus basis points of excess capital, that signals supreme confidence in achieving those higher lows in the next downturn.
So how do you execute that bet on quality?
You put on the long MS position, and you get leverage to management's own capital return. That rising dividend and the buybacks create a floor. Then you hedge out the broad market cyclical risk by shorting a peer that lacks that ballast, a firm that might be engaging in dilutive M&A. At the end of the day, it's a bet on superior capital management over chasing volatile near-term growth.
That's a perfect articulation of that rigor and humility philosophy playing out in the marketing. Okay, so to recap this whole deep dive. A decisive beat on EPS and revenue, the integrated firm strategy is clearly working and taking market share, and you have a management team that's showing incredible discipline for long-term compounding.
Very, very powerful print. It validates a whole business model transformation and puts a premium on quality.
So we'll end with a final provocative thought for you, the listener. We talked about how management is using AI not just for efficiency to cut costs, but for effectiveness, for revenue generation with tools like LeadIQ. Given that they are sitting on over 300 basis points of excess capital, the real question you should be asking over the next few quarters is this. How much of that massive capital hoard will be strategically deployed to accelerate AI adoption across the entire firm? How will they use it to truly widen that competitive moat against peers who are lagging on tech? That technology spend, maybe even more than M&A, is what you should be watching, because that is what will build the foundation for those higher lows they keep promising.
An insightful question to end on. Remember, knowledge is most valuable when it's understood and applied. Thanks for joining us for this deep dive.